Okay, gang, let's go ahead and do a sound check here. I just took everybody off mute, so I'm gonna ask you to mute your own end when you don't have a question or don't need to chime in about something. But we got a pretty good group, so I'm hopeful we can manage all that. How's my sound?
Sound great.
Okay,
Pretty
you guys got good audio, thank you. And I got a little bit of sound coming through on this end. So, and I got a few videos. Let's see. You should be seeing the PowerPoint Module 10 screen right now. Is that what you're looking at?
Yes.
Yes.
Terrific. And I use Zoom all the time for my client meetings, but that's usually usually one-on-one, or maybe we'll get 5 or 6. This is probably the biggest group I've ever tried to set up myself personally. I have a chief operating officer that'll set up a webinar from time to time, but that's when I set up a webinar, I get an opportunity for everybody on the webinar to raise their hand icon, and I don't see that tonight. How's this compare with your other Zoom sessions so far?
This is my first one.
Okay. First one, but so far so good, I guess.
Yeah. I'm the green one, by the way. This is my work laptop. So
Okay.
well covered.
Well, thank you. I appreciate that. Okay, I got, let's see here. I'm getting some. Okay, Topher says, if you can see this, Vern, we cannot unmute ourselves once we mute ourselves. Okay, well, I just clicked a button that said
I appear to be unmuted now.
Okay, so that was on my end. Great.
It's good.
Participants will give, I have some questions about the project. Please let me know when I can ask. Okay, hold on. We'll do that in just a minute here. If someone sees this and has audio.
I was just asking them to mention that people were cut off.
Okay.
You can go into participants to get the hands.
Okay, if I go
So
into.
I could do that, for instance. You should see a hand on me now.
Oh, I see a hand. Okay, so you have it on your end. Okay, great. Okay, so anytime anybody wants to ask a question, use the hand or just chime in. I'm not gonna mute everybody. I think we can manage this. If it gets to be too much background noise, then we'll stop and I'll put everybody on mute. But until then, seems like we're ready to go. So it's a little after 7. Looks like everybody's been able to access the Zoom room. So so yeah, let's start with some general housekeeping issues, and then we'll talk about the project and anything else you guys want to talk about. The first thing I wanted to do was share some results of the second exam. So here's a little histogram of the second exam. I got results. You can see here that the grades ranged from a low of in the 60s to 70s, low in the 60s to high of 140. So had 12 participants up there in that high range. And then you can see 36 participants are right here in the 130 to 140. So most of the class had a pretty reasonable time with the exam. And if you're one of those that fell down here, and that's probably most of the time that's just life getting in the way, and I get it. But if it's not life getting in the way and we have some communication challenges or you're struggling for one reason or another, you can always feel free to reach out to me. I try to have a pretty receptive ear to those kinds of things. And obviously life is, well, it's more stressful for most today than it has been in a long time. So let me know how I can help, and if there is a way I can help, I'll try to do it. And that's really all the commentary I had on the exam. I was pleased with the scores, and we've been gone for a couple weeks now, and tonight I'm planning on lecturing on Module 10, and we'll start with any questions that you guys have on the project first. But Module 10 gets us through the most challenging and technical lecture of the semester. Once we get through module 10, we got 11 and 12. They're not nearly so tough, and that's all of the testable material. So we're really kind of in the home stretch here. So with that, I'm just going to pause and take any questions that you guys have before we get into the lecture. Somebody had specifically mentioned in the chat room that they wanted to ask about the semester-long case project. So let's see here. I lost my little.
Professor, this is Paul. Can
Hey,
you see
Paul.
my comment inside of the chat room?
Let me see here. When I shared my screen, I lost my chat room again. Let's see, chat. Okay. Yeah, I have book 4E. Could this be the reason for my low scores? I don't know. I don't know. Is that not the latest book? And Paul, I can't hear you again, but that's a good question. And if that's not the latest book, I would, to get on the My Business Courses website, you have to pay the fee that gets you access to the most recent book. So I guess I would just kind of direct your attentions there. If you bought an older hard copy, you might just kind of cross-reference that material against the book that comes with the online edition of the My Business Courses software would be my advice there. Oh, Paul says 5E is the latest book. So yeah, just cross-reference that with the 5E material, and that may have something to do with it. Although, I mean, tonight we're going to be talking a little bit about the accounting for leases, and the accounting for leases just changed, but there's not that much in the curriculum that has changed year over year. FASB they don't make changes very much, and GAAP accounting doesn't change very much either. And when it does, most of the time it doesn't affect this course, because the standards that we review in this course are generally pretty static, with the exception of lease accounting, which we'll be talking about tonight. Okay, well, should be making good progress on your semester case project. Everybody's got a company, everybody's got a proxy analysis, everybody's got a 10K filing, should have compiled all of their source material, and we just finished up spring break, and like I said, we're in the home stretch here, so you should be moving along pretty quick. Here in another couple weeks, we're going to have our third exam, and then after we get through that third exam, the rest of the semester is entirely reserved for work on that case study. So I recognize the temptation in setting up the class like this, that we have some time at the end of the course. So the temptation is to procrastinate a little bit. So I get it. And you do still have time, but try not to procrastinate. It is overwhelming to get to the end of the semester and recognize that all of the examples that I've posted out there on the internet that are quote unquote good examples are 80 pages long-ish. So yeah, just heads up. Let's see, Brian asks about the SMF tool, and I can give you zero help on the SMF tool. It's freeware, and sometimes it works, sometimes it doesn't. Somebody else in class found out earlier in the semester that some of the links to one of the sites were broken. So if you're savvy with that kind of software, maybe you can repair those. But yeah, it's just something that's worked in the past, and if it's not working for you, then best I can say is you're going to have to go to Bloomberg or Morningstar. Ellen says no Bloomberg now. Good point. So Morningstar has all the same data. You can go there and find that all, and then you'll just have to hand key it into that front cover, the Excel sheet that goes on the cover of your reports, and that's probably a 20-minute task. Okay, what are we going to do for the presentation now? Good question. We obviously won't be able to get together, so I'm just going to ask you to shoot a 3-minute video, no more than 3 minutes, 3 minutes max. I'll have 30 of these to watch, so 3 minutes max, and send it to me. Best way to do that's probably to post it to YouTube and send me the link. So that'll be fun. Take all the anxiety off of anybody that doesn't like to speak in public. Okay, another question. Can it be on our phones, phone video? Sure. Yeah, absolutely. No problem. But then you're gonna have to get me the file somehow. So that's no biggie. Yeah, everybody's got the phone. So just shoot a little 3-minute video and you'll be good there. Okay, so I'm going to do a new share here and go back to. Okay, should be back on module 10. Can we see that okay? Okay, got some head nods, thank you. Okay, the authors are, I don't know, man. They're just mean. They're just mean when they put this module together, because we got 3 of the most intensive and technical subjects that we're going to be reviewing all semester, and here they are in the same module. We're going to be talking about the accounting for leases tonight, we're going to be talking about the accounting for pensions tonight, and we're going to be talking about the accounting for taxes. And when we get to that section, we'll talk about the differences between IRS books and FASB books, because believe it or not, companies keep 2 sets of books, and there's a difference in the accounting that each of those sets of books utilizes, and that differences causes a fun little line item called a deferred tax asset or a deferred tax liability. And it has taken me forever to understand deferred tax assets and deferred tax liabilities. I don't know, it's just one of those little hang-ups in accounting. Every time we get to that section, I got to go back and just kind of mentally anguish my way through it, because it's complicated. So we're going to take our time tonight. I'm hopefully going to give you some guidance as we navigate this tough course material, and we'll go from there. Okay, but it all starts with leases, and everybody knows what a lease is. I'm sure everybody in class has leased the car or rented an apartment. This is the same basic financial transaction. We have 2 parties. We have the lessor and the lessee, and that's another one I can never seem to get straight. The owner of the asset is the lessor. Always got to underline that one. And the person borrowing the asset is the lessee. This slide here generally outlines the terms of a lease agreement, which I won't belabor. Like I mentioned, prior to 2019, there were different accounting standards for the treatment of leases. And those different standards allowed for 2 types of leases. It allowed for a capital lease and an operating lease. And the operating lease is what you think of as a lease when you lease an asset. And I think our authors use the example of Southwest Airlines. And Southwest Airlines is a great example because they lease all of their airlines. Hertz rental car might be another good example. Let's see, a trucking company might be another good example. Lots of fixed property, plant, and equipment that doesn't show up on the balance sheet because it's actually owned by somebody else. That's an operating lease. And really, under an operating lease, the only impact to the financials is in a line item called lease expense. Well, that used to be just the way things worked until FASB decided that that was creating some inaccuracies. And I would say, yes, that probably was creating quite a few inaccuracies, because the temptation was for management teams to structure their businesses in such a way that they didn't actually have to go out and buy the assets. They would just enter into long-lived leases And the economics for these long lived leases ended up being the exact same as if they'd bought the assets, but they never had to report either the asset or the debt on their balance sheet, which is advantageous when you're trying to present yourself to the world as stronger than you are from a financial leverage standpoint. Or maybe you're approaching the bank to try to get another loan and you don't want all these loans to show up on your balance sheet. It created some distortions. So that resulted in this kind of bifurcated treatment of leases between capital and operating leases. And I'll share with you some rules that applied again to pre-2019 that help us differentiate whether a lease was going to be capitalized or operating. And as you can imagine, those rules were not necessarily hard and fast rules, but they were guidelines. And that should send up a red flag or a little pink flag, because every time you hear the word guideline or estimate or anything in that vein, it introduces the opportunity for gamesmanship, and we have distortions in the accounting. And if you're wearing your CFO hat or CEO hat and need to play the little game of find the penny, here's just another place that you can do it. New module, new game of find the penny. That's what we've been playing all year long. And this is a great little slide for you all to star, because it has the quick difference between the capital and operating leases. This stuff's great for multiple choice type material. So you can see the just from left to right there, capital leases are they actually do report the asset on the balance sheet. They do report the liability on the balance sheet. You will see depreciation and interest expense both reported, just as if we had actually purchased the asset. And then the cash flows show the payments per the lease contract. So the capital lease, the company might call it a lease, but we're going to call it and record it and put it on books as if it were a real purchase. Operating lease is a little bit more straightforward. Neither one of the asset or liability are reported, and then what does show up is the rent expense or the lease expense. Okay, the consequences of an operating lease. This is another one to slide here. Just dog ear this slide or start or whatever, because this is really good material to test your understanding of the way the classification works itself through the balance sheet and the income statement. So let's just take number one here. The lease asset is not reported on the balance sheet. What's that mean? Well, that means, for one, asset turnover is going to be higher because assets are lower and revenue that's unaffected. So two, the liability isn't reported either. What's that mean? Well, it means that we're going to have lesser financial leverage. So our debt ratios are going to look a little bit better. And then follow that through to number three, without any adjustments. If we leave those, then the portion of return on equity, going all the way back to module number 3 now, the portion of ROE derived from operating activities appears higher. And remember, the portion derived from operating activities was an indication of quality. The higher that portion, the more we as analysts would say that's a really high quality ROE, because it's not due to financial leverage. It's not due to financial shenanigans. We don't go to the bank, borrow more money, and juice that ROE. We're actually having to run our business more efficiently, get more turns out of those assets, and drive higher margins through our income statement to generate that higher ROE. So it has a big effect on the quality of your retained or return on equity. And then lastly, we'll go through this in more detail, but point number 4 here, it will have an effect on the income statement too, as we run that depreciation through the income statement. So in early years, we're probably using an accelerated depreciation method, and that's going to lower our net income because we have more depreciation expense on the income statement. And as we lower our net income, we're also going to lower our taxes and increase our profit margin. So I got a little hung up there because the authors start with an operating lease. So that's a capital lease will be lower net income. The operating lease will be higher net income because the operating lease would not have that depreciation. Okay, let's look in a little bit more detail here. Okay, so why the change? I think I covered all this. We're moving into 2019 standards now. FASB took a look at this lease accounting. They thought that the guidelines, the quote unquote guidelines, were a little soft, and they recognized that managers were manipulating the accounting. So they made a change. And that change basically eliminates any opportunity to not capitalize the leases. So in effect now, with the new standard, there is no such thing as an operating lease. All leases are capitalized as if they were purchased. And that's going to make our lives easier as an analyst, as an accountant eventually, because all these will be treated the same. But it makes our lives much more complicated as we're working on these case projects, because the accounting that you're looking at for the last 3 years has been reported under different standards. So if you have a company with a lot of leases on your books, this is a very important topic for you, because it's likely that you're going to have to go back and make some adjustments. One, so that you can compare the accounting year over year. Hopefully your company has issued some pro formas. They likely have. But two, so you can compare your company to different peer groups that might be on different standards. So if you do have a significant exposure to this, be mindful of that. And if I can help give you guidance there, bring it to my attention, and I'll be happy to do so. So here's the new accounting treatment. This is 2019, and thereafter, everything is in effect going to be capitalized. But I just cringe. I don't know who at FASB is in charge of the terminology, but this just, they left operating lease as a description underneath the new standard. So there's no such thing as an operating lease as it applied to the pre-2019 standard. All leases are effectively capitalized, but there's still a new categorization that they call operating lease, which is not the same thing as an operating lease under the old standard. So I write in the little margin of my PowerPoint here, don't be confused by the confusing new terminology that's the same as the old terminology. So I don't have any mnemonics or creative ways for you to memorize this or know this, other than just brute force memorization. Nonetheless, let's go through it here. So new standard. A finance lease is where the lease transfers control to the lease asset, to the lessee, and is effectively like purchasing the asset. And we'll look at the guidelines associated with a financing lease. Now here's the new definition of an operating lease. And remember, it's capitalized now, but the new definition of an operating lease is that the lessee controls only the use of the lease asset, but not the asset itself. So in effect, what are we really talking about here? Well, both of these categorizations of leases are going to show up on the balance sheet. We're going to put an asset on our balance sheet, and we're going to put a liability on our balance sheet with both of these, both a new finance lease and a new operating lease. The difference is how we treat them on the income statement. With a finance lease, we're treating it like a purchase. So we're going to record depreciation and we're going to record interest expense. With an operating lease, we're not treating it like a purchase on the income statement. So we're just going to record rent expense, and we're not going to record any interest expense or financing charges associated with the lease. Okay, let's see if I can clear that up here over the next couple slides. Okay, slide number 10 here gives us the guidelines that I was referring to, and FASB calls these certain tests. So how do we know if something is a finance lease or an operating lease? Well, let's look at 1 through 4 here. Number 1, the lease term compromises the major part of the economic life. So FASB draws a line there at about 75%. 75% was actually the line under the old standard. Now it's quote unquote major part. So you can see we still have a fudge factor in there. And these affect the income statement differently, like we just talked about. So if there's a fudge factor and you can define major part probably as anywhere from 60% to 90%, then there's your game of follow the penny right there. Number 2, the present value of the lease payments comprise quote unquote substantially all, a lot of subjectivity in the term substantially all of the fair value of the lease asset. Formerly, that was a strict 90% rule. Number 3, the lease transfers ownership. Okay, that's a clear one. If you're going to own it at the end of the lease term, done, finance lease. Number 4, the lease grants a bargain purchase option to the lessor. Okay, if maybe it doesn't transfer ownership, but if you can buy the airplane for $1 at the end of the lease term, we're just tidying up some loose ends there and making sure we don't have any loopholes. Although you can clearly see from number 1 and 2 that there will be a few loopholes in those. Footnote disclosures, find this table. The authors give us an example here. I think this might be Southwest. And if you have material exposure to leases inside of the company that you're doing some work on this semester, find this table. What I want to know, and what you should want to know as an analyst, is what payments is the company on the hook for over the course of the next 2, 3, 4 years? How does it affect its liquidity? And are there going to be any challenges with coming up with that cash? So you should understand your company well enough at this point to recognize very quickly if, in the instance of Southwest, they're going to be able to generate $636 million worth of cash to pay these operating leases in 16. So 16, they need 636 million, 620, 550, 470, 350 in 2020. It's a lot of cash they got to come up with. And in an environment like we're in today, where the airlines have effectively been shut down, what's the likelihood they're going to come up with that cash? Well, probably not very good unless they're in line for one of the bailouts that just got signed last week under the CARES Act. So for the airlines and other, I forget how the CARES Act described it, but there's big companies that have been affected. So the airlines are obviously, this money's obviously available to the airlines, I think hotel industries, and there's a lot of discretion that Congress has given the Fed and the banking system to pass out some of these loans. But Congress earmarked, I think it was $500 billion for these types of loans to large businesses. But then they took $400 billion of that-ish, and they gave it to the Federal Reserve, and the Federal Reserve has been tasked with monitoring that loan program through our banking system. Well, the Federal Reserve is a bank, and they're going to function like banks function, and they're going to lever that up, meaning that they're only going to keep approximately 10% on their balance sheet of what they end up loaning out. So they'll be able to lever that up by a factor of 10. And Chairman Powell has effectively communicated that they will, quote unquote, do whatever it takes, which puts nearly $4 trillion worth of loans and monetary stimulus into the hands of the Federal Reserve to administer over the course of the next 6 to 8 months while we navigate this crisis, which is one of the reasons why you saw the market react like it did with the most aggressive upside move, nearly 10% last week when the package was announced. That was the most aggressive upside move in the markets that we'd seen since 1933. So really quite remarkable there. One of the weird things about teaching on Zoom is that we get almost zero interaction. So, you know, again, if you want to chime in or have a question, feel free. You're welcome to. Okay, constructive capitalization for operating leases for analysis. If you're working on Southwest or another company that has material leases and you're trying to compare against other peer groups or competitors that might have used a different kind of accounting. So say Southwest is accounting for their planes under the old operating lease standard, pre-19 operating lease standard, and you want to compare it to a company that's capitalizing the leases, well, you can go through the prompts here on slide 12, which is called constructive capitalization. And what that means is we're going to look at an operating lease and we're going to back it out of the financials and we're going to adjust the financials as if that had always been reported as a capitalized lease. So to do that, we're going to kind of go through and make adjustments. And as we do make those adjustments, you're going to see here that the operating profit margin is understated. So only depreciation expense is included in operating profit, as interest is a non-operating expense. When we capitalize the lease, we correct for that. We also correct for asset turnover that's overstated, and we correct for financial leverage that's understated. We just went through those on a prior slide. Now we're adjusting for all those, and we're going to get to see what the balance sheet looks like if we had capitalized those leases all along. And you'll get some homework that walks you through the opportunity to do just that. Here's the 3-step process that you'll want to go through when you're capitalizing what was formerly an operating lease. Number one, we need to determine the discount rate. We're going to have to determine the present value of the future lease payments. We know what the future lease payments are. We just looked at that table. I told you to go to the footnotes of your 10K and find that table. Well, when you find that table, you'll have the future lease payments all laid out for you there. You can compute the present value of those lease payments if we know what the discount rate is. And we can take a guess at the discount rate. There's a couple different ways that we can do that. Once we know the present value of those lease payments, we're going to put that on our balance sheet. That becomes the lease asset, and we'll have a corresponding lease liability that we also put on the balance sheet, and then we can recompute our asset turnover and financial leverage, and now we have a direct comparable. Okay, great. Okay, Topher. Yeah, you just can't. Okay, I just unmuted all. Sorry about that. Thanks for chiming in. Okay, how that happened?
I'm gonna mute myself real quick and just see if I can unmute again.
Okay. Nope, unmute all. Okay.
Can anyone hear me?
I can hear you.
Okay, so I'm on.
Yeah, so once we mute ourselves again, that seems to leave us muted and unable to unmute.
Okay, so I take that back. You can chime in for exactly one question. Make it a good one, because then you're muted for the rest of the class.
Exactly.
Okay. Manage participants. Let's see here. More. Allow participants to unmute themselves. Why don't I check that box? There we go.
I think right now we can unmute ourselves.
How about that?
Right?
I'm learning something. I'm learning. Thank you.
Looking good now.
All right, now you can chime in and stop me and whatever. Okay, done with that slide. Step 1, do constructive capitalization of a lease. Go to that table that we talked about in the back of the 10K. Find these lease payments that are listed in the Excel spreadsheet here between column C and column L. Type those in. We know that those are going to occur over the next 10 years. And then we're going to impute a rate of return for those lease payments. That's if they disclose the capital leases, we can impute the rate of return because we're going to define the yield that indicates the present value. So in that instance, we need to know the present value. If we don't know the present value, we can take a stab at what we think that interest rate is going to be by just looking at the company's credit rating. So circle this one right here, number 2, blue bullet point number 2, just circle that one. I don't know why anybody would go through the trouble of plugging all these numbers into an Excel spreadsheet when they could just use the credit rating and the corresponding interest rates that's associated with that, that's going to be close enough to the interest rate that you would use on a capital lease. If you do it that way, Southwest Airlines is going to come out to somewhere around 3.94. That ought to be about the same rate they're paying on the least expensive issuance of their debt. And it would be least expensive too, if you're looking at their debt. Least expensive because these are going to be collateralized loans. And anytime you put collateral up, you're gonna get the best interest rate that you possibly can, or the best deal from any lending institution. Okay, step 2. We know the interest rate. We have the leases laid out per the disclosure table in the footnotes. Plug all that data into a spreadsheet and we come up with our present value, in this case, 3.1 billion. 3.1 billion is now the value of the asset and the liability we're going to put on our balance sheet. You can see here on slide 16, we're adjusting total assets by 3.1 billion. We're adjusting total liabilities by 3.1 billion. And all of the profit margin, asset turnover, profitability ratios that we've gone over in class beforehand are subsequently adjusted. So profit margin declines, asset turnover declines, return on assets declines, financial leverage goes up. Now, remember, return on equity is not changed at all. The only thing about return on equity that changes are the components. So return on assets will change, financial leverage will change, but return on equity will stay the same. So while return on equity stays the same, the quality goes down. And you can see how the components of that, well, you can see how they come together to lessen that quality. Okay. And just talked about that. So I had covered all the points on that slide. Okay, let me check my notes here. Adjustments for operating versus non-operating disaggregation of ROE. Take back the module. I forget where it was, where we spent all the time on operating versus non-operating parts of the income statement. And every time we look at just any little piece of accounting, we can disaggregate it into how it's affecting operating and non-operating, and that's what our authors are doing here. But there's a couple takeaways I wanted to make sure that I noted on slide 18 here. Okay. So when we go through this process, when we go through this process, our authors are pointing out here that the adjustment to the assets will affect our operating assets, but the adjustments to the liabilities affect non-operating liabilities because that's going to be posted to long-term debt. So if it's Southwest Airlines, then the operation of your aircraft are clearly in your operating activities. But we would finance that with long-term debt, so that second aspect would be non-operating liabilities. Similarly, we can identify these sections of the income statement that are affected here. Depreciation expense, that's an operating expense, so operating expense would go up. Interest expense is a non-operating expense, so that would affect the non-operating section. And then lastly, rent expense would be operating as well. So just be mindful of that. It's another manner in which we deconstructed ROE earlier in the semester. Okay. And then I'm going to move beyond that into pension analysis and disclosure. So another fun one. And I will say that Dr. Larry Kruger has retired at this point, but you all missed out on one of the most entertaining lecturers and course material that used to be Dr. Larry Kruger's introduction to pension and the accounting for long-term benefits and healthcare. Brilliant lecturer, and he used to, I remember when I was going through my master's in accountancy program at UMKC, so going on not quite 20 years ago now, he used to spend 3 or 4 nights on this material. And that's, yeah, I mentioned that only to say you can go much deeper into this than we're going to go in this class. We're just going to touch on the surface and how this accounting treatment and how these accounting practices have an effect on the financial statements. But this can get extremely complicated. And think about what we're trying to do here. In this section, we're predominantly going to be focusing on the accounting for defined benefit pension plans. And I suspect that most of you in class have dad or uncle or granddad or somebody in your family tree or a friend of the family that has retired with a defined benefit pension plan. So for me, that was my granddad. He worked his whole life for Phillips 66. He managed a pipeline transfer station and put 35 years in with Phillips. And when he turned 65, he cashed in a defined benefit retirement plan and a check started showing up in the mail. He never had to think a day in his life about logging into a 401k account to check his balance or figure out how much he needed to be deferring or what his company match was or whether or not he needed to be in a target date fund or large cap value fund. Never had to ask any of those questions. He just knew that when he retired, the check was going to start coming. It was great for granddad. But now think about that same basic transaction from the perspective of Phillips 66. So my granddad retired in 1985. So that meant he went to work for Phillips somewhere around, 85 minus 30 is 1955. So somewhere in the mid 50s, Phillips had to say, okay, Don Cushenberry was just hired. If he works here for 30 years, we're going to owe him a retirement package. And here's what that retirement package looks like. It looks like a check showing up in the mail to his house for the rest of his life, and then for the rest of his spouse's life. And because he robbed the cradle, my grandma's still cashing checks almost, what would that be? 30 years after he retired. So now it's your job as an analyst in accounting to understand what the present value of the commitment that Phillips 66 has just made to my granddad and put it on your financials. And not only that, but you have to figure out what the value of that is for thousands and thousands, probably tens of thousands of workers that you have deployed globally. So yes, the accounting for this can be extremely complicated. And I think just walking through that, you can probably understand why defined benefit pension plans are kind of going away. They're still out there. There's still a lot of money in them, but nobody's launching a new one. That's what you go to work today for any sizable business and you're going to get a defined contribution plan, which is number 1 here on slide number 22. Defined contribution plan is the company simply saying, here's a little bit of money. We don't owe you anything in the future ever again, because you'll get a match. You'll get 2, 3, 4, 5% of your salary. You contribute a little. Your employer contributes a little, and then your employer is done. They're out of the equation forever after that. And your retirement is 100% left up to you to manage and fund and monitor and ultimately to cash out and start collecting checks, which leaves you entirely responsible for not only the accumulation phase, but also now the decumulation phase. And newsflash, most of the employees who participate in 401k plans don't have the master's in finance degree that it takes to coordinate all that over their investing lifetime, which is why you see participants that are near retirement, they have on average an account balance of about $120,000, which will create approximately $5,000 per year in retirement. I'm in this industry, and Google has learned that anything that has the words retirement plan crisis, I will click on. That's clickbait for me. It used to be that I'd get a couple articles a month. Now I get probably 24 articles a week talking about the retirement plan crisis. So the defined benefit plan system works great for retirees, not so great for corporate America. The defined contribution plan system works great for corporate America, not so great for retirees. I won't spend much time on defined contribution plans. The accounting for those is simple. It just goes into wages payable. There's no accrued liability that lasts on the books for forever. Not forever, but 30, 40 years. So it's our job to estimate that. And that's, again, that ought to be, at this point in the semester, the biggest word on the page, estimate. That creates an opportunity for huge distortions. And when we're dealing with these types of liabilities that are 30 to 40 years in the future, they're huge. Even a 1/10 of a point in discount rate or interest rate or the assumed salary inflation rate can have very large distortions on the present value of these liabilities. And very large distortions create huge impacts on the financials. So if you need to find a penny, this is a very easy place to do it, which is one of the reasons why, we're going to get to it here in a minute, FASB says that these types of fluctuations go in the basement. Remember when I was lecturing a few weeks ago and I called comprehensive income the basement? That's the section of the income statement that falls below net income. Net income is supposed to be the bottom line. Well, the bottom line is not really the bottom line, because there's something below the bottom line that I call the basement, and FASB calls it other comprehensive income. Well, distortions that flow through the defined benefit pension plan that are on account of changes in estimates that we make, those are in other comprehensive income. We'll get to that in a minute. Last note on slide 24 was footnotes. Always check the footnotes. You'll get a wealth of information about the assumptions that were made that drive all of these plans, and that's homework for all of you to go back to your 10K filings and understand the assumptions that are driving your defined benefit plans, if you even have one. Not every company that we're looking at this semester will have a defined benefit plan. If you don't, check the box and move on. But if you do, you need to be familiar with every term that we're reviewing here, and you need to understand how it affects the financials of your company. And what I want to know is what the assumed rate of growth is on the investment portfolio. So Phillips 66 takes a little portion of my granddad's salary or an earmark every month, and they put it into an account, and that's an investment account that's supposed to grow over time. Well, how fast is it supposed to grow? The faster it grows, the lesser our current liability is. So we're gonna disclose what we think that growth rate's gonna be, and that's gonna be in the back of the 10K filing. Now, what should it be? Well, how do you come up with that number? You ought to be able to look back at the history of the markets over the last 100 years and recognize that on average, the market's grown at about 9%. So there's a reference point, but we don't have most of those portfolios invested 100% in stocks. We usually have some safer assets mixed in there. So 9's probably a little high. Should be something less than 9, 6, 7, 8. So check it out. If anybody in class has 7 or higher, bring it to my attention, because that's just way too high, and that's an instant sign that your company's playing some shenanigans with the accounting.
Given that we've just hit a major downturn and boomers are now finally retiring, how gross is this going to get with pensions being already underfunded?
Yeah, you're gonna see a lot of bailouts. I think that there's going to be some question as to whether or not the PBO is going to be around in a few years. I expect it to get worse, and corporate America is not the worst case story. When you look at underfunded pensions, it's really municipalities and state governments that are the worst of it. Chicago, New Jersey, Illinois as a state, you're looking at funded ratios of 30, 40%. So a funded ratio, and we'll talk about that here in a minute. If you look at plan assets and you compare that to PBO. So PBO is your projected benefit obligation. I apologize if I moved. Yeah, I think that might have been on the last slide. I apologize if I moved it over that too quickly. PBO is your projected benefit obligation. That's the present value of all your estimated future benefits. So to calculate PBO, we need to know, again, think about this from the perspective of Phillips 66. I'm using the example of my granddad. Phillips needs to know how many employees they have, how many of those employees will reach retirement age while employed at the company, what their salary levels will be at retirement age. So while my granddad went to work in 1955, he was probably earning 2 or 3 or maybe 10 times his initial salary by the time 1985 rolled around. So you have to have assumptions built in to calculate for that. How many years of service they'll have at retirement, because the retirement package is typically linked to total years of service. And then the years over which the annual payments will be made. So we have to have estimates for all of that. Once we have those estimates, we can calculate what our projected benefit obligation is, and we'll compare that to the pension plan assets that we actually have in the fund to calculate funded status. So simple numbers. We got a PBO of $100. We got plan assets of $100. We have a funded status of 100%. Got a PBO of $100. Got plan assets of $50. We have a funded status of 50%. So you get down around 40%, 30%, 50% less. You're in a lot of trouble. You're not going to be able to make those payments. And look at if you're
Chris, I have a
working
question for you.
Yeah, please.
Okay, so far as the reasons why those municipalities pension plans are underfunded, why do you think that is? Do you think they've been borrowing against those pension plans, or why? Because with Social Security, because they borrowed against it like so much. Why do you think? What about the municipalities? Why do you think they're underfunded? Just a side note, but I just wanted to add.
They're underfunded for the same reason that how do I say this? They're underfunded for the same reason that I'm getting a new kitchen, which is we all have immediate wants right now that we're balancing against long-term issues that we're trying to fund. And my wife wants a new kitchen, so we have a line of credit with the bank. We can tap into that pretty easy for kitchen expansion. But to do that, we have to sacrifice the payments going into our pension plan. So I have this all figured out. I'm a financial analyst. I have probably the savvy and the knowledge and the wherewithal to do that well, but most people don't. And balancing those long-term commitments is an extreme challenge if you don't have the financial acumen that comes with a master's degree in finance. And if you don't have that, then the short-termism is always a factor in reaching for those funds to, I don't know, fund the next near-term need at the cost of the longer term. I don't know any better way to say it. I think if you're a politician, that's a good way to get yourself reelected. You go out and you buy the votes. And as a matter of fact, it's not. We don't have enough data to prove this out at the level of statistical significance. I'll put that caveat on there because we're in an academic setting, and I like to make sure that what we teach has statistical significance, especially in the world of investing. But there is a lot of chatter out there about the investing in presidential election cycles. And when you get to the 4th year of a presidential election cycle, so exactly where we are now, President Trump, or any president that's in his first term, is trying to get himself or herself elected, as the case may be, reelected, as the case may be. So what do you do if you're trying to get yourself reelected? You go spend a whole bunch of money and you buy votes. Well, a lot of times you're spending money you don't have. You're putting yourself further in debt. You're not funding your pension plan assets. And over time, that has a tendency to just lead to lesser and lesser funding ratios. So if you're a municipality or government of some kind, well, at any point you can fund that. you just fund it with higher taxes. Corporate America doesn't necessarily have the same lever. Now, when you fund it with higher taxes, who's going to pay those taxes? Well, usually the workers. So you're transferring what in some cases are some very generous pension plan businesses onto the backs of younger workers to pay with higher tax burdens. So there's a lot of political implications to something like that, and I won't go into that. You guys can just interpret that however you want. Okay, pension expense. Let's talk about the income statement. Let's talk about how this affects net income. So on an annual basis, we're going to accrue and run through the income statement the changes that are normal. And the normal changes are like with my granddad, well, he works another year. And when he works another year, that projected benefit obligation is naturally going to go up a year because he accrues a year of wages, a year of service, he gets closer to retirement. And that all is what we call pension expense. And that's going to flow through the income statement on an annual basis. Now, just a moment ago, I mentioned the increase expense, which would be like a gain or loss associated with any actuarial changes to the assumptions, the underlying assumptions that we make that allow us to calculate that projected benefit obligation. Those go into comprehensive income, but eventually we have to get them into pension expense. They got to move from comprehensive income up into regular income. So FASB allows us to amortize those changes in estimates over a period of 10 years. And those amortizations show up in pension expense. I'll look at that here in just a moment. Hopefully I can add a little clarity to that. Here's a little graph on page 28 that basically says the same thing I just said, I hope, but a little bit more clearly. So you can see that pension plan assets are comprised of the following. You got the beginning balance plus any actual returns on investments. So this is what I ask you to look in the back of your 10K filing and find. I'm hopeful that the assumption of actual returns is somewhere in the neighborhood of 6%. So we add actual returns, then we add the company contributions to the pension plan. Hopefully your company's making contributions every year. Might be a 1 in 10 year exception. This would be a good exception year. 08, 09 might be another acceptable exception year. Then we're going to subtract benefits paid to retirees. That gets us with pension plan assets at the end of the year. So every year we're going to go through that calculation. On the liability side, remember, this is our projected benefit obligation. We already walked through all of these estimates that we had to know to calculate that PBO at the beginning and ending of the year. So we have our beginning balance. To that, we're going to add service cost. So that's the additional increase in the PBO on account of a worker just hanging out another year longer. Service cost plus interest cost plus actuarial gains and losses. That's what I just mentioned. Any changes in our return estimates or the increase in salary over the life of the worker, so on and so forth, are going to go right here in this line item. We're going to subtract benefits paid to retirees, and at the end of the year, we get a projected benefit obligation ending balance. Funded status, just covered that, no change there, pretty simple formula. And here's the pension expense. So I launched into this a little prematurely. The components of pension expense that shows up on the income statement include these 4 items. So this is another great page to star and be able to come back to at a moment's notice if necessary. So that service cost that just went into the PBO calculation, that flows directly into pension expense on the income statement. Interest cost described in PBO above. The expected return on pension assets. So this is big. Let me go back a page. Notice the difference between actual returns. Actual returns affect pension plan assets. But here, when we get to the calculation of pension plan expense, we're not looking at actual returns. We're looking at some other definition that we call expected return on pension assets. And this is where, you know, I mentioned at the top, the accounting for pension plan liabilities can get very, very technical. And one of the reasons it can get so technical is because FASB looked at the distortions that annual returns in the market and two pension plans were creating on the income statement and said, no, we need to smooth that. We need some smoothing mechanism so that we don't render the financial statements useless on account of such wide distortions. And we've experienced that this year already, right? On Monday of last week, the market's hit an intraday low of down 35%. Well, we can't just go and take a pension plan. Obviously, our assets decreased by 35% on that date. But if we're Phillips 66 and we have pension plan liabilities and assets that are in the tens of billions of dollars, well, we are now at risk of running an expense through our income statement that will make every other number printed on that income statement absolutely meaningless by comparison. So FASB says, we know the way the markets work over the long term. These are long-term assets. Let's just print on the income statement an expected return. So every year we're going to figure out what our pension plan expense is based on an expected return of 6%. 6, 7, 8. Find out what it is again. And using that number, we'll create a smoother plan expense and thereby eliminate the challenge associated with wide distortions in the pension plan expense. And then lastly, amortization and deferral amounts. So any assumptions that we've made to the underlying calculation of the PBO, well, the gains and losses on that are going to show up down here. And you see the other comprehensive income, AOCI. They're first going to be booked to comprehensive income. And then over time, we're going to amortize those. And that amortization expense is included in normal pension expense. And that's how we deal with those large distortions over time. Okay, that's a lot. Come back and spend some time with that slide. Okay, slide 32 here. Bear with me, I just want to check my notes here again, make sure I'm not missing anything. Slide 32 talks about some of those changes in actuarial assumptions that have such outsized impact on the PBO. Change in any of these will affect the PBO liability. Okay, we talked about all that. Yep. Unexpected returns on pension plan assets. So the difference between expected and actual returns also shows up in accumulated other comprehensive income, and then both of those are amortized over time. So we have covered all that. Fair value accounting for pensions. Everything that I've just talked about is the way I see most companies do it. But FASB does tell us that it doesn't have to be that way. You don't have to run expected returns through the pension plan expense number. You don't have to smooth it. You can actually record the whole gain or loss as a fair value number at the time that the market corrects. And when you do that, you'll see those very large fluctuations in profit on the income statement. So this example was AT&T, and you can see how these gains and losses that were reported in income were from 2010 to 2015 were negative 2 billion, 6 billion, negative 8 billion, and then positive 8 billion, then back down to negative 6 billion, positive 2 billion. They're just huge. So if a company's using this type of accounting, what you're probably going to have to do as an analyst is back those out so that you can understand the nature of the operating business that is really at hand. And the main point of this slide is what happens when we as analysts, or really probably most investors that haven't taken an advanced accounting class, how they interpret the wide swings on a company's income statement. Because there are big swings. When you move from a bull market to a bear market, it has a huge effect on these assets and liabilities. And if you don't understand what's going on, and you don't have some, just basic handle on the long-term returns available to patient investors in the market, and by that I mean, don't panic. This is just a bear market. We've been through a dozen bear markets this century. We always come out the other side with reasonable returns. If you don't get that, well, you're looking at the balance sheet of a company like GE here, and you're thinking that something is fundamentally wrong. And, well, that's going to change the way you manage the company. That's going to change the way you think as an investor. That's going to change the way you behave as a banker. Every constituency, every stakeholder is going to make different decisions if they don't understand how this accounting is affecting the underlying economics of the company. Here's an example of the footnote disclosure that I want you to go find. This one is for AT&T or somebody, I forget which, but you can see the PBO at the beginning of the year. You can see each of the components of the PBO, the change in plan assets. What this disclosure doesn't have are the assumptions involved. You probably get those in the fine print right underneath this. And then you'll get pension expense broken down in a similar fashion. Okay, covered all that. Okay, we're about to wrap up this section here. And as we do, I'm going to ask you to find another table that's very similar to the one that we looked at for leases just a moment ago that quantifies the future benefit. So these are the payments that are coming due from this plan in the next 5 years. So this has to do with liquidity again. We need to make sure that your company has the cash flow generating ability or access to capital from a line of credit or a banking institution or just general bond market to be able to cover all these. So find out what these cash flows are, find out when they're coming due, and just confirm that your company has a plan for managing those cash flows. Here's the table that I wanted you to find with all of the assumptions. This table has the discount rate for the benefit obligation at about 4%. Okay, very reasonable discount rate to determine the periodic benefit, rate of increase in future compensation, so on and so forth. Expected long-run return of assets, so that's at about 7.75. That's a little on the high side. A little on the high side. I'd like to see that closer to 6. So that might be cause for concern. Here's a good little table summarizing what we just talked about there. Given the assumptions that we just looked at, if they change, depending on what direction they change in, that's going to change the liability or asset associated with each one of those. So just spend a little time with that table. And bear with me here. I want to make sure that I cover what needs to be covered, but I don't need to belabor some of these points that are that are more straightforward. Which was this chart and the next chart. Okay, I wanted to get to other post-employment benefits. So just like Phillips 66 promised my granddad a retirement, they also promised him other post-employment benefits because he and my grandmother both had health insurance and they continued to pay that until they were both on Medicare. So these are long-lived liabilities and they are not reported on the income statement or balance sheet. They are only reported in the disclosures at the back of the 10K filing. But they're real liabilities. These companies are really going to owe them. They are really going to get paid, and we as analysts need to know what they are. So find that schedule, and it's really your job as an analyst to make sure that these are immaterial. Make sure that they're manageable, immaterial, not likely to have a meaningful effect on the cash flows or near-term operating of the business. And as long as that's the case, you're going to be able to check the box and move on. But every once in a while, you'll find promises that have been made that result in huge liabilities to the company. And because GAAP doesn't require those to be reported on the face of the financial statements, it now becomes your job as an analyst to put those on the face of the financial statements. Make the adjustments so that you have an accurate viewpoint into what this company's true underlying economic position really is. And we can make those adjustments. Okay, learning objective number 3, I want to jump into this here real quick, but before I do, I need to get a little refill and take a break. So let's pause here. We'll take 5 minutes. My watch says 8:12. We'll come back at 8:17 and jump into tax report.
Okay. Hey, is there somebody forgot his notebook last class in the classroom? Message me personally.
Hey, Ellen, how you doing?
I'm good. How are you?
Doing good.
I posted a picture. Could you message me personally, privately? I can.
So how do I do that?
I can send you the picture of your test book. I think it's yours.
Let me see if I could. Oh, okay. Okay, hold on.
Okay. Sorry.
So did you get it?
Yes.
Okay. Where's this picture at? Let me see if I can.
Okay, picture I sent you now. Did you receive it?
Let me open it up.
Is that yours? Test book.
Downloaded.
Here, black keys. Inside are all colorful print.
Oh, I'm trying to find somewhere to put this at. Right.
Hmm.
Okay, hold on. I think it's it works.
I can't hear you very clear.
Are you able to hear me better now?
Oh, now it's better. Yeah. Okay. Oh.
Yeah, I'm still here. Hey, it's saying I can't open the file. Okay, hold on. Let me try.
Carl also.
Let me try opening it another way.
Okay. There's another classmate message me. Okay. Carl,
Yeah, it's not gonna allow me to open it. Hey, here, I'm just gonna send you my email address and you just send it to me.
Okay. Because it doesn't have a name on it. Yeah.
Yeah, because hey, so how are you doing? We got to unmute ourselves because otherwise everybody can hear us.
Okay.
We'll just type, okay?
Okay.
Hey, Ellen, can you hear me?
Yes. Yes, can you hear me? Yes, I can hear you. Can you hear me?
Ellen, I'm still hearing you in the general channel.
Okay. I mean the general channel?
Yeah, whatever you want to call it, where everyone's talking. There are breakout rooms. I don't think any are set up for this course, though.
Yeah, Topher is right, Ellen. There is no breakout room. So you got the only way you can, if you want to talk privately, you have to send a message, you know, on the chat. That's the only way.
Okay.
And assume that that is only private to other students and not to the professor.
Yeah, exactly. So what I'll do, Ellen, I'll just send you my phone number, okay?
Okay. I'm sending you the picture through email now.
Okay, thank you.
You're welcome. Picture. Okay, here it is. Okay.
Ellen, can you guys hear me?
Yes, I can hear you.
Yeah, Carl, you can be heard.
Okay, let me check it. Okay. That is my book. So that's the beginning.
So, Vern, how are you liking the t-shirt life?
Yeah, this is great, isn't it? For my client meetings, I'll put on the what they call an outfit mullet, I guess. So I'll do the shirt and tie, and then just pajamas or whatever on the bottom. It's terrific. Yeah.
I'm not even bothering putting on collared shirts at this point for teaching. It's just like, I'm going to
No.
from now on.
Yeah, I don't think anybody cares.
My students definitely don't. I don't know about your clients, but.
Had you used Zoom before?
Just once before all of this.
Okay. Yeah. Seems there would be a pretty good platform. I've been reading about some security concerns, but I haven't talked to anybody that's been affected.
They like to cozy up to Facebook and share everything they can.
Hello? Ellen, can you hear me?
Yeah, we can hear you. Who was that? Was it Carl?
Yeah, that was Carl. Hey, Carl, there is no way to talk on this privately. Okay.
Yeah, any actual audio is going to go to everybody unless there are breakout rooms set up, and that's on the host to set up. So assume you won't get it for this class because we just don't need them generally.
Gotcha.
So let's jump into it again. Learning objective number 3. Talked about leases, talked about accounting for pensions, and then this is just another one of those squirrely accounting treatments that get squirrely because we have 2 sets of books that we're trying to reconcile. The IRS is a function of our government, and every we just got a new tax package last year, and there's new tax treatment associated with different aspects of the CARES stimulus bill that was just passed. And every time Congress acts to put an incentive in place or change tax treatments, that affects the cash flows of corporations all over the country. And when they file returns to the IRS, they need to be reflective of that. But FASB, which sets the rules for GAAP, doesn't necessarily agree that those tax rules make for the best representation of financial statements as it pertains to usefulness and measurability and the other standards that they adhere to when they set up an effective accounting system. So that creates this system where companies keep two sets of books. We have a set of books that we keep that are in accordance with GAAP, and then all companies have another set of books that they keep that are in accordance with IRS tax reporting. And we're going to go through the differences between those two sets of books, and we're going to see how those differences create deferred tax assets or deferred tax liabilities, depending upon, sometimes you'll have higher expenses under one and lower expenses under another. And depending on which one's higher and which one's lower, you'll either end up with a deferred tax asset or deferred tax liability. And you'll see how the accounting treatment for different transactions creates that. So with that said, let's jump in and analyze how this comes about. I just hit all those points. Okay, so good introduction. Let's see here. Slide number 50 gives us some more background. Okay. The primary example that we're going to look at tonight that creates a difference between financial accounting and tax accounting is going to be depreciation. And we use that example because it's one of the simpler ones that create these deferred tax assets and deferred tax liabilities. And you can recognize that because we've looked at accelerated depreciation methods in the past in this class. For the purposes of accounting, the IRS allows for companies to use accelerated depreciation. But for the purposes of financials, a lot of companies choose to use a straight line depreciation method. And the difference between those two can have some advantageous effects in terms of tax payments, but it also creates distortions on the accounting. So let's look at how that unfolds here. So in this example,
is there another name for straight line method?
Say that question again, Mohammed.
Is there another name for straight line method?
I've always heard it just called straight line.
Because for the other one, I think there was another name, reducing balance method.
Yes, there's several names for what you see on the screen here in red is an accelerated depreciation schedule. And there's several different types of accelerated depreciation. You just mentioned the double declining balance. That's one. A lot of times you might see MAKERS. MAKERS is another acronym for accelerated depreciation. And you'll run into other types as well. Straight line is just straight line. And that's the simplest type of depreciation that you'll ever run into. Take the useful life and divide it into the value of an asset, and that's how much depreciation you're going to book on an annual basis.
All right, thank you.
So in this little diagram here, you can see that for tax purposes, we're going to record approximately $200 in depreciation expense in year one. But for financial purposes, we're only going to record about $100 in depreciation expense in year one. Now think about what this does. In year one on our financials, our expense is smaller. That means that our earnings before interest and tax is larger. So our earnings before tax is also larger, which means that our earnings are going to be larger. But for our tax purposes, we want more expense because that's going to drive our taxes down. I didn't say that very well, but we'll look at, I think on this next page here, you can actually see how those numbers come about. So let's walk through this in detail and make sure everybody has a firm understanding of how these cash flows are flowing. So we're going to start with income before depreciation of $200 in both instances. Now we have depreciation, and we're using different methods. For financial reporting, we're using straight line, which is just $50 a year. $50 a year every year until we've exhausted the useful life of that asset. For tax reporting, we're using an accelerated depreciation method, which means that in the early years, it's going to be above 50, and in the later years, it's going to be below 50. In this first year, it happens to be 75. So our income before tax is 150 for financial and 125 for tax purposes. And then our income tax is 40%, and that's just simple math. So we're going to report a $60 tax expense on our financials, and we're going to report a $50 tax expense to the IRS. And this is what we actually paid. These are our cash taxes paid. So you can see this is a favorable difference. And that's the reason why we chose to utilize straight line for our finances and accelerated for our tax reporting, because we just saved $10 in taxes. And that adds to our liquidity, creates flexibility. We can use that money to go get employees paid, to expand our business. That's a real and material positive economic impact on our business. But you can see that it creates a difference between the net income as reported, GAAP versus IRS. And that difference is recorded down here in this transaction. This is how the deferred tax liability gets on our books. So we're going to record the tax expense as follows. So we record the tax expense as 60. So that's what we calculated up above in the left-hand column underneath financial reporting. So draw a line from that 60 up above down to the tax expense below. That tax expense is comprised of $50 in cash. We know what the cash paid to the IRS was. So draw a line from the right-hand tax reporting column where it says 50 cash paid down to the cash column. And then the difference between the expense that's recorded on our books and the cash that's actually paid to the IRS is called the deferred tax liability. So when our expense is greater than the cash paid, we will record a deferred tax liability. When our expense is less than the cash paid, we will record a deferred tax asset to plug the difference. And that's what's going to allow our balance sheet to ultimately balance. Now remember, I said that when we use straight line up above, our expense each and every year is 50. When we use accelerated, our expense in the early years is above 50, and our expense in the later years is below 50. So in the later years, you're going to see exactly that. The expense is less than the cash outflow. As that occurs in the later years, you're going to see this deferred tax liability reverse itself. And we will, instead of crediting that account, we will debit it, and you'll see that balance go to zero. Okay, now let's take this a step further. So now we're in year 2. And in year 2, we see the reversal of this. So these numbers are so simple. We started with straight line depreciation. I say these numbers are so simple, like you should immediately understand that. That's not what I meant. This is a complicated, this is complicated material. I know the depreciation numbers are simple because this is an asset that depreciates itself in 2 years. Look over here for tax reporting purposes. We've already, underneath an accelerated method, we're already below 50 now. So straight line 50 is our expense here in year 2. Underneath our accelerated method, our expense has already dropped to 25. Our income tax, our tax expense is 60 again, but our cash paid is 70. So if you look down below, you see the entry that we booked on the previous slide is going to reverse itself. So here we have tax expense at 60. Our cash outflow is 70, and we're debiting our deferred tax liability account for $10. Now this gets a little complicated here because I just told you that if the tax expense was less than the cash outflow, you'd have a deferred tax asset. Well, in this instance, we don't have a deferred tax asset. We have a negative deferred tax liability. And that's a little bit of a tomato type of thing. If you have a deferred tax liability account with a balance in it, you'll just lessen that balance. The effect on the balance sheet is identical. If you don't have a deferred tax liability already on the balance sheet and your expense is less than your cash outflow, that's when you would actually book a deferred tax asset. Excuse me, you'd see the deferred tax asset show up on the balance sheet. Let's look at an example of how that deferred tax asset would occur. Okay, slide 55 is going to walk us through that. And our authors, at least initially here, are using the example of what are they using the example of here? Oh, next slide. They are using the example of restructuring accruals. So here's a little pop quiz. When are we supposed to restructure? Anybody know the answer to that one? The answer to that one is as soon as you get the CEO job. Because remember how restructuring works? When you announce a restructuring, you immediately book the expenses associated with that restructuring. And that's right here in the first bullet point. So in the year in which a company approves a reorg plan, it will accrue a restructuring liability and recognize restructuring expense. So the game you play as the new CEO is you come in, you say, oh gosh, things are much worse than I thought they were here. Don't worry. I have a restructuring plan. I have it all well under control. We are going to right the ship. 6 months later, you come out, you make a big show out of saying we have righted the ship. I have done such a good job. It cost us much less than I ever thought it was going to cost us. And on account, we're going to reverse a lot of the expenses that we booked 6 months ago. Those now show up as a gain, and you take all the credit. And really, it's just accounting shenanigans. But we're back talking about restructuring accruals again in Module 10 because they have effect on deferred tax assets. So once we book those expenses, we know that for tax purposes, those restructuring costs are not deductible until paid. So now we have an expense that's been booked in period 1, but we're not going to deduct that for our taxes until the cash is paid in the future. So we have an expense that's higher than the cash paid. Anytime we have an expense that's higher than the cash tax paid, it results in a deferred tax asset. And another example of a deferred tax asset is something that we call a tax loss carry forward. So the IRS gives us the ability in any year that we lose money to take a credit for those losses against future earnings. And that credit against future earnings is a real economic benefit, and we will book that as a deferred tax asset. And we can credit a deferred tax asset against future gains. Now, FASB does have some rules around that, and if your company has any deferred tax assets on their balance sheets that are associated with prior losses, they have to be in a position where their auditors believe that, quote unquote, it's more likely than not that they will have gains in the future to which they can offset those losses. If their auditors don't believe that's true, that they'll have profits in the future, then they're going to require your company to book a valuation allowance against those deferred tax assets. Look for that. Look on your balance sheets and first recognize if there are any deferred tax assets associated with prior year losses. And if they are, do they have any valuation allowances booked against them? There'll probably be some disclosure language associated with that. Find out what it is. Okay, just hit on all of that. So here's an interesting one. American Airlines was in exactly this situation. They had a deferred tax asset on their books. Their auditors were not confident they were going to be immediately profitable in the future. So they had a deferred tax valuation, which is a contra asset account that their auditors forced them to record. Now, in future years, when you actually do become profitable, you still get to make use of that deferred tax asset. And as you do, that deferred tax, that valuation account will have to be removed. And that can be a good place to go look for profitable investing activities, because if you have the inside track on a company that has a valuation allowance booked against a deferred tax asset on its balance sheet, and you think they're likely to reverse that, well, that's going to show up as a huge gain on their balance sheet. So if you can get a jump on other investors in recognizing future profitability that hasn't yet been booked, then that's an investing opportunity, because you can front run that a little bit. And I've seen investors make good money on that many times in the past, because auditors are a little bit more conservative than investors are. And they're going to require more evidence to remove that deferred tax asset than we all might as investors, if we know a little something about the way the industry works, and maybe we've started to see a turnaround or identified the bottom of the economic cycle, or whatever. For whatever reason, we just think the company's fortunes are about to turn. Here's the income tax disclosure that you'll be looking at. Find this for your company. Recognize that you're going to see the current taxes. Those are going to be broken out in federal and state, total current. And then you're going to see the deferred. And this is the deferred tax asset and the deferred tax liability. And these show up for all kinds of different reasons. And all those reasons are going to be disclosed in a separate table. Now, the current portion plus the deferred portion total to what is called the provision for income taxes. This is the number that shows up on the income statement. So it has both of the components that we've been talking about here embedded in that number. And here's your deferred tax liability, deferred tax asset breakdown. I don't know if this is AT&T or what we're looking at here. Maybe this is Southwest again, because they have deferred tax assets associated with fuel derivative instruments. And those are pretty large numbers. And I don't know how they're accounting for their fuel derivatives, but obviously there's something about the tax treatment of those that has created a deferred tax asset. And you know how long the IRS code is. You can get deferred tax assets and deferred tax liabilities from almost an innumerable number of different transactions, because that IRS code is so long. And in this class, we just don't go that deep, but just know that they can crop up for all kinds of different reasons. And we just touched on a couple of the major ones so that you can understand in broad brushstrokes what a deferred tax asset and deferred tax liability is. Tax rate reconciliation is something else that you all should have a handle on for the companies that you're looking at this semester. Statutory tax rate's 35%. Most companies don't pay 35% though, because they're savvy about how they structure themselves, and they're savvy about where they're doing business, and they're savvy about taking advantage of whatever advantages are available to them in the tax code. Some people call them loopholes, but I'm generally of the mind that these were all passed into law for a reason at one point in time, and that reason is usually to encourage some type of corporate behavior. And we as a society got together and said, yes, that corporate behavior is advantageous. So if companies are taking advantage of that code, then that's a good thing. But a lot of people who take issue with that interpretation of how our government operates, and I don't begrudge you if you're one of those people. Nevertheless, it's still your job to find this table and understand the reasons why your company might not be paying the statutory tax rate of 35%, because they're probably not. And in the instance of Southwest Airlines here, they are paying about 19%. And you can see that the reductions come from non-US income tax at different rates. So Southwest is a global company. They operate all over the world, and they get credits for taxes that they pay in different geographies. There's also a 2.9% difference for settlements, effective settlements, related measures, domestic manufacturing, deduction benefit, research and development tax credits, so on and so forth. So just be familiar with that. And then our authors walk us through Intel, which I won't go into. Okay, analysis of income tax disclosures. What is this slide telling us here? An increase in deferred tax liabilities indicates that a company is reporting higher GAAP income relative to taxable income and can indicate the company is managing earnings upward. Maybe. I like how the authors are thinking here. I encourage everybody in class to think about the world of accounting with a skeptic's hat on. So that's a good bullet point right there. The second bullet point reads, reduction in deferred tax asset or the valuation allowance may result in an increase of net income if it arises from a change in estimates about the recoverability of a deferred tax asset. So that's really a different way of phrasing the same conversation that I was talking about there, where I said you can gain jump on the market if you've identified the low of a company and their likely recoverability, the authors say here. And then lastly, the reconciliation of statutory and effective tax rates can reveal important statutory items that might impact our forecast of future tax rates. And that, again, is because if you have a deferred tax liability or a deferred tax asset on your books, those are transitory, meaning just like with depreciation, those are going to reverse themselves over time. And that happens with all deferred tax assets and all deferred tax liabilities. And that's our lecture tonight, gang. There's a couple of appendices that I don't need to lecture on. Appendix 10A, use the calculator and present value tables for lease calculations. Well, that's present value stuff, so I'm not going to lecture on that. Just skim it at some point between now and the exam if you need a refresher on present value. So with that, I will pause for questions. Just remember that we're still on the schedule according to the syllabus. So next week, I'm going to let the recorded YouTube lecture do the talking again, and just connect with me over email, phone call, text message if you have any questions. And then I'll see you back again in 2 weeks for a live version of this. And then before we adjourn, does anybody have any questions or comments or discussion topics that we need to get out on the table?
I have a question. Will we be able to get into the exam too to see what we missed?
You will be, but I had a student with a good reason why they couldn't take the test in that 2-week period. So I had to open it again. And I think I left it open through the weekend.
Okay, sounds good. Thank you.
Yeah.
Yeah, so, okay, so Professor, so I don't know if I told you this or not, I can't even remember, but I think I let you know that I'm going to have to choose another company because the company that I originally chosen, it just couldn't find a lot of data on it.
Yeah.
I don't know if I told you that or not.
Yeah, I think you mentioned it to me, and if I didn't tell you, if you haven't already chose it, make sure you're looking at that Morningstar list and make sure you pick something that they do have research for.
Right, right.
That'll really save you a lot of work.
Okay, all right, gotcha.
Yep.
So I'll probably have to choose a company that someone else has chosen as well. Is that okay?
There should still be companies out there that nobody else has chosen. Look for those first.
Okay, gotcha, will do.
For our presentations, is the plan for us to collectively see them, what we upload to YouTube?
I never thought about that. It's okay with me, but
I didn't know whether the plan was to do something else in those periods or just not meet those weeks or to watch those collectively or what the plan was.
well, you're not going to be graded over them. You're only going to be graded over the one you submit. So you'd be a real special kind of person to watch everybody's uploaded YouTube.
I still have cash to invest right now.
I just assumed I'd be the only one doing that, but yeah, you're welcome to. I can share them with you.
For class then, for the weeks when we would have been doing presentations, are we not doing that then?
Well, yes, we are not doing that then. Yes. Okay, gang, I'm going to say goodnight. Thanks for joining me. I thought this went about as smooth as we could have hoped for, but between now and next time, if you have any suggestions, recommendations, I am all ears. And stay healthy, or at least asymptomatic.
Thanks. Have a great night.
Good night.
Okay, thank you.